On a Thursday afternoon, we welcome you at the American College of Financial Services to this week's webcast, our monthly forum regarding special needs planning. Today, we're going to cover tax traps and financial nuances for families caring for those for individuals with special needs. My name is Tom Brinker, and we're going to cover a lot of area today and items that you typically do not see or we stumble over when involved with planning. And I want to preface this by sharing with you, when we look at this particular area, it's not going to be as black and white as I would like it to be, because number one, we're looking at 2020. And with the change of leadership in this country, undoubtedly, you're going to see a significant number of tax changes. Will those changes be retroactive to 1/1/21? We don't know. Will we revert back to a pre-Trump administration in terms of tax policy? It appears that we are, but nothing is etched in stone. So again, today's topic, identifying tax traps and financing nuances for families caring for individuals with special needs. I'd like to start by looking at our tax formula. Now, this is our tax formula for 2018, 19, and 20. We look at income in the broadest of senses, meaning economic income. See, economic income represents that which is both taxable and non-taxable. Then we subtract exclusions. Exclusions represent those items of income that are simply not subjected to taxation. For example, the death benefit on a life insurance policy, gifts, inheritances, interest income on a tax-free municipal bond. The starting point really in preparing your tax return is gross income. From that, we subtract what they call above the line deductions. Deductions for AGI. AGI has been, is, and will continue to be a critical point in our tax calculation. Adjusted gross income is the gatekeeper. And it's going to become more important in 2021 than it even has been in recent years. See, AGI determines what credits our families are entitled to. And a credit is a dollar-for-dollar reduction of tax. AGI determines, in the past, whether your overall individual itemized deductions are being phased out or you're losing your personal and your dependency exemptions. That appears to be coming back. AGI determines whether or not you can claim passive activity losses. AGI determines, and we all know this, whether or not you receive a stimulus payment. That $75,000 threshold or that $150,000 threshold for those who are married filing jointly. But under current law, once we determine AGI, we subtract the greater of your itemized deductions, Schedule A, or your standard deduction based on your filing status. Now, we all know the standard deduction is incredibly high right now. It is $24,800 in 2020 for a married couple filing jointly, plus an additional $300 for those of us who make cash contributions to our favorite charities. Will it remain that high in 2021? We don't know. But under current law, we subtract the greater of your itemized deductions, Schedule A, or your standard deduction. And currently, only 1 out of 6 Americans are even itemizing their deductions. Well, that determines taxable income. We calculate our tax. From our tax, we subtract federal withholding, estimated tax payments, credits. Do we owe our federal government money, or does our federal government owe us money? Here is our landscape as of today for 2021 as well as 2020. We still have 7 tax brackets. the lowest being 10%, the highest current tax bracket 37%. Prior to the Trump administration, the highest tax bracket was 39.6%. And you want to keep that in mind. It appears to be coming back. Long-term capital gains, qualifying dividend income, well, they're potentially taxed at 3 different rates. 0% for those in the lower tax brackets of maybe 10 and 12%, 15% for those in tax brackets above that, and 20% for those that are in the pre-Tax Cuts and Jobs Act adjusted long-term capital gains breakpoints. Now, the breakpoints are mentioned right here. You're going to incur a 20% tax for your long-term capital gains, your qualifying dividend income, when your taxable income exceeds $445,850 and you're single, $473,750 head of household, and $501,600 if you're married filing jointly. Well, believe it or not, you're not in the highest tax bracket at those breakpoints. You're in the 35% tax bracket. Now, with the Tax Cuts and Jobs Act, we keep in mind that the highest current marginal tax bracket is 37% federally, and that kicks in for 2021 at $628,300 if you're married filing jointly. Now, kind of an anomaly, for those that enjoy cocktail party chatter, the 37% kicks in at $628,300. Well, the maximum long-term capital gain tax rate of 20% or qualifying dividend income rate of 20% kicks in at more than $125,000 less in taxable income. You want to keep in mind for planning too, there still is that 3.8% Medicare surtax, the unearned income Medicare contributions tax, which went into effect back on January 1st of 2013 as part of the Affordable Care Act. So conceivably, you may be paying on your investment income 23.8%. Medical expenses. And we've had changes as recently as December 27th with CARES 2. Who may deduct medical expenses? Now, first of all, you're only deducting medical expenses if you itemize your deductions. Now, this is something a lot of our families welcome. Medical expenses, your unreimbursed medical expenses are deductible, but only to the extent they exceed 7.5% of your AGI. So if your AGI was $100,000 and you had $8,000 in unreimbursed medical expenses, you would be permitted a deduction of $500. $8,000 less 7.5% of your AGI. Now, the third bullet, kind of a historical trivial bullet. Hey, the limit was 7.5% of AGI prior to 2013. With the Affordable Care Act, it remained at 7.5% of AGI through 2016 if you were 65 years of age or older. But it was 10% for the rest of us who were under the age of 65. Now, the Tax Cuts and Jobs Act, late 2017, they reduced the threshold for everyone for 2017 and 18 to 7.5%. Now, late 2019, the Taxpayer Certainty and Disaster Tax Relief Act of 2019 retroactively dropped it back to 7.5% for 2019 and for 2020. On December 27th, 2020, the Taxpayer Certainty and Disaster Tax Relief Act, part of CARES 2, has permanently set the AGI limit at 7.5%. a welcome change. So what is an eligible medical expense? Under Section 213 of the Internal Revenue Code, medical expenses include any amount you would pay for diagnosis, cure, mitigation, treatment or prevention of disease, or for the purpose of affecting any structure or function of the body, and transportation primarily for and essential to the above medical care. Well, transportation, last year they allotted 17 cents a mile. This year, 2021, it dropped again, 16 cents a mile. Now, for our families, we often overlook some significant medical expenses, and we're going to hold a webinar on earmarking, identifying these expanded medical expense deductions. Capital expenditures for medical care. Capital expenditures are significant big ticket items. Special schools and institutions, we'll talk about that at a later point. Medical conferences and seminars. Now, we're not allowed a deduction for everything. You're not allowed a medical expense deduction for that which is illegal. So even if your state allows medical marijuana, since it's illegal at the federal level, not tax deductible. Cosmetic surgery, not tax deductible, unless it's for reconstructive surgery for a deformity, a disfigurement arising from trauma or disease. Trips to improve general health and non-prescribed medicines, drugs, vitamins, and health foods. Now, I will look into answering all of your questions at the end of today's session. Now, here's where it gets a little funky, a little odd. Impairment-related work expenses. This is something which is typically overlooked by our families. An impairment-related work expense is not only an income tax item, it's potentially a Social Security Administration offset to your accountable income. But it's often overlooked. The Internal Revenue Code under sections 67D and 190B3 will allow us a business deduction in lieu of a medical deduction, therefore avoiding the 7.5% of AGI limitation for attendant care services at the place of employment. Handicapped individuals, according to the code, and again, the code was written in a lot of respects decades ago and may be offensive. Handicapped individuals are defined as those having a physical or mental disability. Example, blindness or deafness that functionally limits employment, and or a physical or mental impairment. Example, impaired sight or hearing that substantially limits one or more major life activities, such as performing manual tasks, walking, speaking, breathing, learning, or working. Now, this could stump Ken Jennings, our new guest host of Jeopardy. Where can you deduct this? Well, first of all, these are expenses that would enable the individual with a disability to work. And they could involve hiring a driver to take your son or daughter to work every single day, Uber expenses. These itemized deductions appear on your Schedule A, and they can be deducted if you do itemize. However, they appear on line 16 of your Schedule A. Line 16 is blank. For years, I have affectionately called this the Clint Eastwood deduction, the deduction with no name. So it appears on line 16 of your Schedule A, but there's nothing on line 16. When you look at the instructions for Schedule A, they refer you to publication 529. Here they talk about impairment-related work expenses. So what are they? They are ordinary and necessary business expenses that are necessary for you to satisfactorily perform your work. For goods and services not required or used other than incidentally in your personal activities and not specifically covered under any other income tax law. Now, here's why it's so valuable. If your son or daughter who has a disability is filing their own tax return and they itemize their deductions, this benefit's available to them. You would report this on Schedule A as an unreimbursed employee business expense that is not subject to the 2% of AGI limitation. See, it's not deemed to be a miscellaneous itemized deduction. So there is no 2% of AGI limitation, nor is there a 7.5% of AGI limitation that would apply to medical expenses. Okay, you may be saying, well, my son or daughter who has a disability is collecting SSI or SSDI, but they are working. Well, we all know to the extent they are working, that can potentially reduce or eliminate their SSI or SSDI. Impairment-related work expenses are a dollar-for-dollar reduction of their countable income. So for example, with SSI, we know the first $20 of income received per month is not countable. The first $65 of earned income, not countable. Impairment-related work expenses are deductible from that countable income, which may mean by factoring this in, your son or daughter may not be losing any of their SSI. We'll cover that in a future webinar, just trying to whet your appetite here. This is something I see a lot on tax returns. And let's face it, our families will do whatever it takes to help their son or daughter, whatever it takes. And I've been there. So it's not uncommon to tap into your retirement plan. And why might you do that? Because for a lot of these parents, their focus is on surviving today, one day at a time. If you're working with these families, it is very, very hard to get them to think about retirement. I have had families liquidate their retirement plans to pay for ongoing medical care today. Now, a little known exception. We know there's a 10% penalty for a premature distribution from your retirement plan from your IRA. However, that penalty will not apply to a distribution amount that is less than or equal to an individual's allowable medical expense deduction in excess of 7.5% of AGI, regardless of whether the individual actually itemizes deductions or not. And that is missed. Here, the distribution needs to be used to pay for ongoing medical care. So what you're looking at here is we have this Form 1099-R showing a premature distribution from our IRA, our retirement plan. Typically, if you're under the age of 59 and a half, there's a code 1 on that Form 1099-R. Code 1 means 10% penalty applies, no known exception. Well, that's not true. If you're using that distribution to pay for ongoing medical care of anyone, not just someone with a disability, to the extent you have a deduction for your medical expense, that means your unreimbursed medical expenses exceed 7.5% of AGI. The dollar amount that exceeds 7.5% of AGI means you can void the penalty up to that amount. Well, you may be thinking, how does that happen? Number one, you will have to attach a Form 5329 to your tax return. And you want to focus on line 2 regarding exceptions to the penalties. It is penalty exception number 5. Penalty exception number 5, and we'll look at some examples. See, the penalty waiver only applies to that component of the distribution which is included in your gross income. The income tax still applies to the taxable distribution. Now, the tax law doesn't require that individuals first deplete the 10% penalty exception for medical care by using the non-taxable component of a distribution first. So what if, hypothetically, part of the distribution represented a return of your after-tax investment? Well, the part that is not taxable on the Form 1099-R isn't factored in. In addition, the penalty exception for itemized medical deductions will apply even if the taxpayer is receiving substantially equal periodic payments. Meaning if you have annuitized another stream of retirement income, you can still invoke this exception. However, with regard to an IRA distribution, Section 72T2 Cap E and Cap F applies the medical expense exception first before looking at other exceptions. Okay, here's the fun part, right? Let's crunch some numbers. I have my trusty abacus with me, and of course my pocket protector. Here we have a non-itemizer. This is the person claiming the standard deduction. Your thinking is, why do they need your help? They do. Mr. and Mrs. Paul, both age 50, have an AGI of $30,000 for the year 2020. The Pauls incur and actually pay $9,000 in qualifying medical expenses on behalf of their child with special needs during the year. Their allowable medical deduction will be $6,750 for 2020. Now, how do we get that? Well, their AGI is 30,000, so 30,000 at 7.5% is $2,250. They have $9,000 in unreimbursed medical expenses. So if they had itemized, they would have had a medical expense deduction of $6,750. Now, I want us to think about this for a minute. And this may not be your client because the Pauls, more than likely, maybe they're renting an apartment, they don't have a mortgage, they have very little in terms of itemized deductions. So they may not typically be one of your clients. But look at what happens if they're ignored. Okay, so the Pauls have $30,000 of AGI. They have a standard deduction of $24,800. They're not itemizing. That means they have taxable income of $5,200. 10%, the regular income tax bill is $520. Well, you may be saying, well, they have a child. Well, if their child is 17, their child doesn't qualify for that child tax credit. Maybe they would qualify for a $500 other dependent credit. But with taxable income of $5,200, okay, you could be looking at $520, maybe a $500 credit, $20. But what about having a retirement plan distribution? What if that $30,000 included a premature distribution of $5,500? Well, if we do nothing, they're going to owe $550 in penalty. But they shouldn't owe anything. So how do you avoid paying that penalty? They don't itemize their deductions. For the Pauls, you attach the Form 5329 to their tax return. On line 2, you indicate exception 5. You attach a medical expense statement showing all of their unreimbursed medical expenses less 7.5% of AGI showing the IRS what the medical expense deduction would have been had they itemized. Bazinga! They don't pay the penalty of $550. That's not a bad outcome, and for the Pauls, I assure you, that's a lot of money. Now, what if the retirement plan distribution had been $8,000? Well, if you do nothing, they owe $800. But if we prepare the Form 5329, we attach the unreimbursed medical expenses, the worksheet reflecting $6,750 in deductible medical expenses. Well, as we'll see in a second, that means they're on the hook for only $125. So here's the outcome. And you can always opt to do nothing. And I found when nothing is done, it's not because people don't want to do anything. It's just you don't see this. For the Paul family, a $5,500 taxable distribution from a retirement plan would not be subject to penalty in 2020 if you attach the proper paperwork. If the taxable distribution was $8,000, only $6,750 would escape the 10% penalty because that's the dollar amount that exceeds 7.5% of your AGI. The balance of the distribution, $1,250, will be subject to a 10% penalty of $125 in 2020. A more common example, Mr. and Mrs. Smith, both age 50, have an AGI of $90,000 for the year 2020. The Smiths incur and actually pay $28,000 in qualifying medical expenses on behalf of their child with special needs during the year. Okay, so $90,000 at 7.5%. $6,750 is the threshold we need to overcome. We have $28,000 in unreimbursed medical expenses. You have a Schedule A medical expense deduction of $21,250. Now, we all know this, right? This one's a little bit easier because they're going to have a Schedule A. So the IRS sees the medical expense calculation on the Schedule A. You still need to complete the Form 5329. You still need to complete that line 2. Will the penalty waiver apply to a $20,000 retirement plan distribution? Yes. So you indicate the amount of the retirement plan distribution that qualifies on that line 2. How about $24,000? Ooh, $24,000, well, it's $24,000 minus $21,250, $2,750 times 10%. That's a penalty of $275. If you do nothing, it's $2,400. So here we have it, a $20,000 taxable distribution from a retirement plan would not be subjected to a penalty. However, if the taxable distribution was $24,000, only $21,250 would escape the 10% penalty. The balance of the distribution, $2,750, will be subject to a 10% penalty of $275. Now, this is an incredibly circular calculation. Why? Well, to the extent you're pulling money out of your retirement plan, your IRA, what happens? It increases your AGI. To the extent you increase your AGI, you have a higher threshold for a medical expense deduction. The higher your AGI, the lower your medical expense deduction, the greater your exposure to the 10% penalty. The tax benefit rule. Now, this is very, very common in our community. We need to know that our children are legally entitled to an appropriate level of education. But sometimes the public school system cannot provide that appropriate level of education. So what do we as parents do? We pull our children out of that public school and we try to place them in a special school, which may mean we're out of pocket tens of thousands of dollars until the township, maybe months or years later, reimburses us. Well, let's see how the tax benefit rule applies here. Refunds or reimbursements of items deducted in an earlier year are subjected to the tax benefit rule. So what is this rule? Okay, in a nutshell, it means recoveries are taxable to the extent you benefited by a tax return deduction. We're told we need to include the refund or reimbursement in income to the extent of the lesser of the prior year's deduction, or the amount by which your prior year itemized deductions exceeded the standard deduction, or the actual amount of the refund or reimbursement. Again, being numerically oriented, I love seeing it played out with numbers. In 2020, Mr. and Mrs. John have an AGI of $125,000. Mr. John is 60 years old. They paid the following medical expenses on behalf of their learning disabled child during the year. $45,300 for a special school, $8,450 in out-of-pocket cost for physical, speech, and therapeutic/behavioral services, and $6,250 for unreimbursed physician-recommended vitamin therapy. Their medical expense deduction is $50,625. So we take the unreimbursed medical expenses of $60,000. We would subtract 7.5% of $125,000, and the excess of the unreimbursed medical expenses over that threshold becomes our deduction, $50,625. Now, their itemized deductions are $80,000 for 2020. An interesting sidebar, a lot of our families, despite being really financially strapped, I'm amazed at how benevolent they are and how much they give to charities. This family may have a significant amount of debt, qualified interest expense deductions, as we'll see in a moment. But they've got $80,000 in itemized deductions. Now remember, $50,000 of that is medical expenses alone. So realistically, $30,000 comprises taxes, capped at 10, mortgage interest expense, and charitable giving. $80,000 is $55,200 greater than their standard deduction of $24,800 for the year that just passed. In 2021, the township reimburses them $45,000 for the special school. Here's the question. And believe it or not, a lot of these townships do not give you any paperwork regarding the reimbursement. And I've had clients say, it must be manna from heaven. It's not taxable. No, it is taxable. So how much of this reimbursement should Mr. and Mrs. John include in their year 2021 income? But what if the reimbursement was received in the year we incurred the expense? Well, look at the outcome. Mr. and Mrs. John must include in their year 2021 income the lesser of $50,625, their 2020 deduction for medical expenses, or $55,200, the amount by which their 2020 itemized deductions exceeded their standard deduction, or $45,000, the amount they actually received. Well, the lesser of the three is $45,000. Now, it sounds equitable, but it's not really an equitable outcome. The $45,000 that is deemed to be taxable appears as other income, line 8, face of your Form 1040. Wait a minute. It's an above the line inclusion. So that means Uncle Sam is mandating that we include this in arriving at AGI. So the $45,000 that we are forced to include in 2021 increases our AGI and is going to decrease our medical expense deduction and perhaps all of our other deductions and increases in phase outs for 2021. That seems illogical for one significant reason. Had the reimbursement been received in the year we incurred the expense, you can net the two. If the reimbursement was received in 2020, their medical expense deduction would have been reduced to $56.25. So you need to be aware of this. The IRS requires that in a subsequent year reimbursement, it is not netted against the medical expense of the current year. Here's the reality, and there have been changes here in 2020. We all know that most taxpayers do not have sufficient unreimbursed medical expenses for a Schedule A deduction. Eligible expenses are only deductible, but they need to exceed 7.5% of your AGI. Minimally, Section 125 cafeteria plans, flexible spending accounts may provide a solution. If you have a flexible spending account at work, why not capitalize on it? See, under your flexible spending account, whatever dollars you are setting aside for medical, dental, vision expense for you and your dependents, well, they not only reduce your federal wages, but your state wages and Social Security wages as well. Now, we'll see in a second there have been changes over the last few months. Number one, after the Affordable Care Act, and a lot of you recall this, over-the-counter meds required a prescription in order to be eligible for reimbursement from a health savings account, flexible savings account, or health reimbursement account. The CARES Act back in March now allows individuals enrolled in these pre-tax accounts to pay for over-the-counter drugs and medicines without a prescription. And that was not a one-year fix. The definition of a medical expense for flexible spending accounts had coincided with the definition of a medical expense under the Internal Revenue Code prior to the CARES Act. Your reimbursables now under FSAs are far broader because of the CARES Act. Healthcare FSA contributions were limited to $2,700 for 2019. They have increased to $2,750 as of 2020. Okay, still people are petrified of using their FSA because of that use it or lose it mindset. But under CARES 2, December 27th of 2020, you can carry over up to the full dollar amount for up to 12 months for plan years ending in 2020 and 2021. So if you're not utilizing it any at all currently, you would have up to 12 months to use it. Now your plan administrator would have to elect into that change. You could also now change under CARES 2 how much money you want to set aside during the course of the year. You can change your mind. We often miss this. Again, think of parents who have catastrophic, unreimbursed medical expenses. They're looking for sources of dollars to pay for these bills. When you look at qualified residential interest expense, this is still another venue we can tap. Interest on qualified loans secured by a primary or a secondary residence are still tax deductible. We have two types of qualified loans out there today: acquisition indebtedness. And the law has not changed here. Any debt you incur to purchase, construct, or substantially improve a residence. up to 2 residences. Home equity debt. Debt secured by a primary or a secondary residence that does not exceed the fair market value minus the remaining acquisition debt. Historically, the loan proceeds may be used for any purpose and still receive a tax return deduction. That's currently not the case. A residence includes that which has basic living accommodations. So when you're talking about acquisition indebtedness, it would include your primary residence and perhaps your vacation home. And a lot of people scratch their heads thinking, why 2 homes? Well, think of who writes our laws. Our elected officials more than likely have a home in their home state and one outside of DC. See, the changes are in bold print, but the changes may not be changes anymore in 2021. Historically, and this goes back to October 13th of 1987, you're allowed to deduct the interest expense on aggregate acquisition debt on up to $1 million of indebtedness in total for 2 homes. $500,000 if you're married filing separately. Now, with the Tax Cuts and Jobs Act of 2017, they dropped that number from $1 million to $750,000. That would be for new homes acquired, new money borrowed as of 2018. $375,000 if you're married filing separately. Now, what if the mortgage is on an older home and you're simply refinancing? Well, you're kind of grandfathered, grandmothered. If you're refinancing a loan after 12/15/17 for property purchased before such date, it doesn't change the $1 million maximum. Here was the big change. Home equity indebtedness, no longer deductible. Remember, you could deduct the interest expense on up to $100,000 if you were married filing jointly, $50,000 married filing separately. But I want us to focus in on acquisition indebtedness. So you can increase your interest expense deduction if your borrowing is to improve your home. Acquisition debt is increased only if capital improvements are made. Home equity debt, well, you can use your home as collateral at any time, but depending upon what you use it for, you may not receive an interest expense deduction. Now, I created this example to really emphasize the point. John and Mary make a $200,000 down payment and they take out a $600,000 mortgage to purchase a residence worth $800,000 in 2013. Their home is currently valued at $950,000 with an acquisition debt remaining at $500,000. So the home increased in value, and they've been paying down the original mortgage. They borrow $200,000 to provide for the ongoing medical care of their 15-year-old son with special needs, and they use their residence to secure this note. Now look at the next bullet. They may deduct the interest on $500,000 of the remaining acquisition debt only, unless they use that $200,000 home equity loan to improve the home, such as a medical capital expenditure. They install an elevator in the home. Their child has a physical limitation, a therapeutic swimming pool. Now look, if you're going to install a therapeutic swimming pool, you've got to avoid the tiki bar and the flotation devices. Constructing entrance ramps. Often you may need to widen entrance ramps, right? Widening doorways and hallways, lowering kitchen cabinets, adding railings, changing the nature of bathing facilities. These are capital expenditures. They would qualify you for an interest expense deduction. For John and Mary, a home equity loan interest deduction will be permitted only if they secure the loan for medical capital expenditures. That is substantially improving the home. If they fail to do that, they can't deduct the interest expense. Now, the overall cap, keep in mind, for acquisition indebtedness is $750,000. Here is the IRS's example, 2018-32. In January of 2018, a taxpayer takes out a $500,000 mortgage to purchase a main home with a fair market value of $800,000. The following month, the taxpayer takes out a $250,000 home equity loan to add an addition to the main home. Both loans are secured by the main home, and the total does not exceed the cost of the home. Okay, the home has a fair market value of $800,000. Initial mortgage $500,000. They tap into a home equity loan, a HELOC of $250,000 to add an addition to the home. Total indebtedness, $750,000. All of the interest expense being paid on these loans will be deductible. However, if the taxpayer used the home equity loan proceeds for personal expenses, such as paying off student loans, credit cards, then the interest expense on the home equity loan would not be deductible. Now, I love the next bullet because I've seen people employ this tactic. So you have your principal residence and you've built up a substantial amount of equity in your principal residence. You would like to buy a vacation property, but the rates for borrowing on your vacation property may be higher than borrowing on your primary residence. Plus, if the second home is being used for rental purposes, and this is where I see it most often, you don't need the interest expense deduction for rental purposes because with depreciation and other expenses, that property is never going to show profit. So what folks would do is they pull the equity out of their primary residence, use that indebtedness to acquire the second home. That's considered home equity indebtedness. That's not deductible at all. Final consideration before looking at your questions, we'll just touch upon this. Individual alternative minimum tax considerations. Hey, the AMT is still out there. Now, we know it doesn't exist currently for corporations, but it still exists for individuals. When you're looking at an individual tax return, the AMT, alternative minimum tax calculation, requires that you recalculate your entire tax return. It's a parallel system of taxation to assure our government that you're paying some meaningful amount of tax. I don't know where they came up with that. Adjustments for individuals only. For those that itemize their deductions, you're not allowed a deduction for taxes. We're capped right now at $10,000 if you're married filing jointly, single or head of household, $5,000, half if you're married filing separately. A piece of good news here, Biden's tax proposal, President-elect Biden's tax proposal will repeal the cap on this, going back again to the pre-Trump administration deductions. No miscellaneous itemized deductions subject to 2% of AGI. For 2016, medical expenses needed to have exceeded 10% of AGI, but only 7.5% of AGI for the regular tax calculation. You're not allowed a home equity interest expense deduction. You're not allowed a deduction for personal or dependency exemptions. Now you'll notice I have an asterisk here. Because under current law, the Tax Cuts and Jobs Act of 2017, we are not receiving any benefit of miscellaneous itemized deductions subject to 2% of AGI. We're not receiving any deduction for home equity interest expense. We're not receiving a deduction for personal and or dependency exemptions. So if you're not receiving a deduction, then clearly there's not going to be an add back for the AMT. So where does the add back, the adjustment for the AMT now come into play? The taxes you have deducted on your Schedule A, $10,000, $5,000 if married, filing separately, or if you claim the standard deduction, the standard deduction is disallowed for the AMT. So let's look at our couple again, John and Mary. John and Mary, from the prior example, paid $19,000 in mortgage interest expense and $11,000 in interest expense on their home equity indebtedness used to finance their medical capital expenditure in 2020. All $30,000 is deductible for regular tax purposes and is a permitted deduction for the AMT as acquisition indebtedness. See, the $11,000 on their home equity indebtedness was for a capital improvement. So now it's classified as acquisition indebtedness and fully deductible for regular tax, and it's not a preference item for the AMT. Note, since non-acquisition indebtedness home equity loans result in no interest expense deduction on your Schedule A, well, if there's no deduction, there's no add back. Take a quick glance at what our exemptions looked like for last year. And this is really why so few people are even paying the alternative minimum tax right now. Look at the exemption amount. Married filing jointly, $113,400 with a phase out beginning at $1,036,800. What the phase out means is if your alternative minimum taxable income exceeds that amount, that $1,036,800, for every dollar beyond that, you lose 25 cents on the dollar of the exemption amount. Now, I know what you're thinking. It could make this easier. So here we have a couple, married filing jointly, alternative minimum taxable income of $1,261,800. Phase out begins at $1,036,800. They're $225,000 above the phase out limit. They lose 25% of that, or $56,250, which means rather than receiving a $113,400 exemption, as we just saw, their exemption gets reduced to $57,150. If their alternative minimum taxable income exceeds $1,490,400, the exemption is zero. For 2021, again, please keep in mind, the exemption does get phased out by 25 cents for each dollar the AMTI exceeds the threshold. And here are the rates for 2021. 26% and 28%. We only have two rates. And when you think of how the AMT has operated for years, with the overwhelming majority of Americans having a marginal tax rate below 26%, the AMT has acted as a soak-up tax. If you're in the 37% tax bracket, if your marginal tax bracket exceeds the AMT rates, the odds are you're not paying the AMT. So it's really an additional tax on upper middle class America. It's 26% on the first $199,900 of your tentative minimum taxable income. Beyond that, 28%. The 28% rate kicks in at 1/2 of that amount if you're married filing separately. Now, a couple of last second nuances. long-term capital gains, qualified dividend income will be subjected to your regular tax rates, meaning preferential. And remember, the rate for C corporations, well, it was 20%. It was repealed as of 2018, but it may come back. Now, I've added a case study here. We can look at this at your leisure, but this is not atypical. Now, I know we're getting close to 3 o'clock. There's a lot of succulent information here. I'm going to take a look at some of your questions. And Ed, his question is, if I pay medical expenses directly to the medical care provider for the care of an adult child of mine, can I claim those expenses on my tax return? If your adult child is your dependent, yes, you can claim those medical expenses on your tax return. Robert, incredible question. For those in the LGBTQ community, transgender folks, and you may not like the answer, but clearly expenses that you would incur are tax deductible. However, there's a litany of case law that shows the IRS has denied them, but the tax court allows these expenses. So if you are incurring expenses for medical purposes, and medical purposes does include those that are undergoing therapy, those who are transgenders, they are tax deductible. The tax court has ruled that they get a tax return deduction. But there are cases out there where the IRS has ruled against it, and you would have to appeal it, regrettably. And there have been a series of articles about that. Here, your question is, if the medical expense was qualified, wouldn't they avoid the 10% penalty anyway? Here, great question. If you notify the party providing your retirement plan distribution or your IRA prior to the receipt, that number one code should not be present on the Form 1099-R. However, firsthand experience, the overwhelming number of families I deal with, they seek the money first. They ask you later what the tax implications are. So the 10% penalty would apply to any premature distribution. You need to complete that Form 5329 and explain to the IRS under what exception you are relying upon to not have it subjected to the 10% penalty. Now, Joanna has a question which really is something I have brought up from day one. If you as a parent are moving into a new community, and this is something we did, you move into a community where you have an enlightened school district, and the sole reason for moving into that community is to obtain the services of that public school. Is it possible to carve out your school taxes and use those school taxes as a medical expense deduction? The IRS has not ruled on that, but it's highly unlikely, Joanna, that they would allow that. I have tinkered with that idea. I've put it out there. I've talked to friends at the service. They said they would get back to me. They have not. So, Matthew, the seminar is being recorded and will be made available. David, regarding your question, grandparents, it may be best for the grandparents to make gifts to the parents of the dependent child, so the dependent child's expenses can be deducted by the parents. Kevin has a great question. We've talked about the ABLE account in prior webinars. The ABLE accounts are great tools. And yes, ABLE accounts can be used to supplement that individual's medical expenses. We're going to have a webinar if not in February, but in March regarding special needs trust. And I would welcome you, Kevin, to attend that. But yes, I believe the ABLE account is a great additional tool to a third-party supplemental special needs trust. And what I have recommended to parents is have the $15,000 distributed from the supplemental third-party special needs trust and placed into the ABLE account, and then use the ABLE account to supplement quality of care, housing expenses. And the ABLE account in Pennsylvania would give you a tax return deduction for up to $15,000 a year. Well, that pretty much concludes our time. I want to thank you all. The college will be making this available. There's a lot of information here that we did go through. I run through a lot of numbers. At the end of the presentation, there is a case study which incorporates this, so you can test yourself in running through the numbers for a 2020 case study. So I want to thank you all very, very much for being here today. And we're trying to have these every single month, free CE for all of 2021. And thank you all again very, very much.